Hello, everyone, and welcome to the Better Policy Project's YouTube channel. Right now, you are watching a live stream about one of the main topics that we frequently addressed at the GFS, which is non-tradable sticky prices, and also one of the tools that we use, which is the chart park developed here. And I think we'll also have time to address the GDP now and the way we use it. To briefly talk about the Global Forecasting School, it is an establishment where we are dedicated to enhancing economic and financial literacy, sharpening critical thinking, and addressing some of the key challenges in modern economics. And non-tradable sticky prices is one of them, because nowadays we see multiple central banks being misled that inflationary pressures are outdated and they're no longer present just by looking at some specific indicators, such as inflation in goods, but not looking at inflation in services, and especially not having indicators for assessing inflation in non-tradable goods. So right now, Diana and Svetlana will discuss non-tradable sticky prices for the cases of Euro area and United Kingdom. I think Diana will be starting today with the Euro area. So the floor is yours. I'm excited about what you have to say.
Thank you, Tina-Jan. So let me share my presentation. Let's start. So I hope you can see it.
Just in case, can you switch the slide because we had an issue last. Okay, great.
I think we can. So once again, hello everyone, I'm Diana from Global Forecasting School, and as Tina mentioned today, I'm going to talk about non-traded sticky price inflation applied to the Euro area. Just let me say that, of course, many central banks had their measures for inflation and for underlying inflation, but in Global Forecasting School with the Better Policy Project, we identified the lack of some measure that can better capture the consumption behavior, also behavioral changes, and the part of the basket that can be highly incorporated with the market expectations. Also, they can somehow highlight the excess demand pressures. So let me briefly say that we were highly inspired by Atlanta Fed's different measures of underlying inflation. You can easily see that they had different measures, and which one was the most inspiring one was the sticky price inflation. And we identified that it can be a good tool, and we of course developed it in terms of separating traded and non-traded part of the basket, because we understood that the non-traded part of the basket can be out from the exchange rate fluctuations, also the real exchange rate movements, and also we skip the supply side bottleneck part. On the other case, in the non-traded sticky price measure, we identified that flexible prices on the non-tradable goods, of course, can adapt easier on the shocks, but the non-flexible part, which is a stickiest part, of course, can contain some information about the feelings, about the expectations, and about the behavioral changes. So that's why even ECB, which is, let me highlight here that non-IFS central bank had its own measure of inflation. We calculated non-traded sticky price inflation for them, because we know that the policymakers should prioritize early warning signals where inflation expectations could become de-anchored. So this is a good signal that could come from non-traded sticky price inflation, that maybe we have some problem with the anchoring of market expectations. So Let me say briefly about the methodology that the non-traded sticky price inflation for euro area cover about 50%, and it's coming from housing and health, personal care, transportation, recreation, and some services from clothing and food fare. So this is the stickiest part of non-tradable goods and services that we elaborated for our calculation. And here you can easily see that the red line is non-traded sticky price inflation, which is smoother than headline. And of course, the acceleration here can provide some important notification about the upcoming stress or about the behavioral changes. So just briefly say that in different cases, we use different variability and frequency for the non-traded sticky price inflation to understand the momentum change in this indicator. Now let's dive deeper and to understand what we can gather from this data. So you can easily see that after COVID crisis, I highlighted here, and during the COVID crisis, the non-traded sticky price inflation acceleration was more obvious here, and even their headline and core inflation was below target. And of course, they relied on their credibility, but non-traded sticky prices gave some signals about the anchoring of market expectations. Let me just briefly remind you that, of course, the inflation acceleration in euro area came mainly from the energy crisis, and of course, it's out of core, and maybe ECB must be more relaxed in thinking about policy rate hikes, but because they missed this trigger that was coming from the non-traded sticky price inflation, they delayed their policy rate increase. So here you can see that the purple line is the euro area's policy rate, and they delayed their policy rate increase because they missed a trigger. And at the same time, some central banks affected sooner and had some, of course, I want to highlight here also Czech Republic, which is 5% central bank. And of course, they started their policy hike sooner than ECB did. And of course, the question here is non-traded sticky price inflation, is this sufficient information for current analysis? Of course not. We don't want to be like model says guys or these indicator says guys. We just use any indicator for some hint and for thinking as an economist. So let me say that within additional information and with this calculated index for non-traded sticky price inflation, we came up to the some consequences. So the first one, it bring us to think that maybe their delayed policy action affected on their harming part of the economic growth. Maybe they delayed this decision, make their policy rates more punishment, and of course affected on the slowdown on their GDP growth, because they affected in much higher way than it could be, because as I mentioned, their inflation just started from the energy shock, and they need just deal from this secondary effect that could be could come from this shock. And of course, I put it here, the GDP growth, we divided the domestic absorption to the external absorption part with export, and you can see that this dark blue one, which is domestic absorption, started to decline, and it was very notable at the end of 2023. And even they had some recovery in the beginning of 2024. Of course, it's mainly driven by the services part, which is drive the tourism sector, especially in Spain, Greece, and also somehow in French. But you can easily see from the PMI on the manufacturing sector that their production is still below 50 for PMI. So it means that their production part is still in downward trend. And of course, as I highlighted before, you can see here that meanwhile, ECB delayed its policy rate hike. US and other advanced economies affected sooner. And of course, somehow they gained here. Let me show you that they managed to sustain more stable GDP. So here you can see the euro, we see USD exchange rate, and you can see that dollar saw a significant appreciation against the euro because the affected on the market expectation the anchoring sooner. So what about the second effect? What we can see here is the credibility loss and inflation expectations. Of course, the credibility is unobserved variables, and to prove that they lose their credibility could be not correct. But of course, we can talk about the inflation expectations. Here you can see 3 years ahead and 1 year ahead expectations. I put it with non-traded sticky price inflation just to highlight the high correlation here, and you can easily see that it's still higher than their target. Even we know that during 10-15 years their average of inflation was much below their target. It was 1.5% or even below, which means that higher expectations. And I want to also emphasize that at the end of the line, it's unchanged. Even we had some decreasing path for their headline and core inflation. So I want to highlight that maybe they lose their credibility even more than even could be estimated. And of course, I don't want to summarize only with this part, because we have the additional part of the market, which is the labor market, which is still hot. So of course, this is opposite part of the economic conditions that make us rethink about the hot economic conditions in the EU at the meanwhile. So the unemployment rate still below the estimated NIO rate at the moment, and of course the wage growth, which was much higher in Q1, it was 5.3%, and even it estimated to have some decline, but it's still higher than their average growth. So which means that we couldn't prove that their decision was the main driver of their downward trend for the GDP growth, but we have also this part of the economic conditions, and also we had seen some tightening in their bank lending standards that was easing, and also during last quarter they identified some warming signs in terms of mortgages loans, which can also affect on the recovery in economic growth. So let me just briefly summarize and say that we need to understand in what world at the moment we are, in case A type world or in case B type world, because if we are in case A and the anchoring is continuing for market expectations and credibility is lost, of course, they will have even higher policy rates, which will be more punishment for their economic growth in the future. On the other side, if they did it correctly and they started to move down their policy rate, and if it's good decision for their policy, we must see the strong cooling signs in their labor market, and of course it will disinflate their economy as well. So this is briefly what we found with our non-traded stick price inflation analysis for Euro area. And if you have questions, I hope I can cover them.
I'll start with the question, and I'll also introduce the guest of today's session. So firstly, the question that I have is, Diana, what do you think? Do you think Euro area should be more cautious about not looking at non-traded sticky prices given its location? So it was heavily harmed by the Russian-Ukraine war. And I think the external factors, the trade factor, which usually confounds the price indices without looking at non-traded sticky prices. Do you think that the price indices are heavily influenced by external factors for Euro area?
I think especially for countries that have more open, let me say, external trade. Of course, it's important to understand how these fluctuations from the external part can affect on their inflation as well. But especially for ECB, I think it's important to understand their policy relevant part of the underlying inflation. So that's why even they can have this effect from the tradable goods, and also it can affect it by their export part, because their export also can be affected from these fluctuations. I think that especially for them is important to put their finger on the pulse of the inflation developments. That's why I think that for them it's very, very important at the moment.
I totally agree, given that Euro area's trading partners are countries in the Western Asia, such as Georgia, Armenia, Azerbaijan, and also Eastern European countries, which are very heavily influenced by oil prices. They mostly oil importers, and they are very heavily influenced by the war. I think I agree with you that looking at non-traded sticky prices would be highly informative for them. Right now, I'll introduce the guest of ours today, Ioannis Halikias, which is a renowned economist from Yale. He's extremely experienced, given that his years of experience at IMF and his multiple projects. I am excited to hear what he has to say about your take on Euro area's non-traded sticky prices.
Thanks so much, Tina, and thanks, Diana. This was quite a nice presentation. Of course, the choosing the appropriate price index to monitor is a central concern of central banks, and there's been a lot written about it also in the literature. Maybe to clarify a little, I think since most central banks target either an overall price index or a core inflation concept, that's their ultimate goal. I think it would be helpful to guide us a bit into the statistical properties of the sticky price inflation. Is it a good predictor of core inflation, for example, which the Fed and the ECB target? Is it a kind of a leading indicator of what we are supposed to expect. So that would be useful to know as a motivation of monitoring sticky price inflation carefully.
Yes, thank you for the comment and for the question. Let me just say that, of course, during a less uncertain times, it's more less flexible. So you can see that it's smoother, and maybe it couldn't have some information that can be more than core. But during high uncertainty times, when non-linearities become alive, I think it could be a nice signal about what's going on the market expectations. Are they change their feelings? Are they change their behavior? Because we identified that during COVID crisis, the flexible part of the basket started to change their prices sooner, and it became more flexible. So these type of behavioral changes, of course, can contain additional signals and information they can be useful for them. That's why we identified that it's, of course, not a panacea, but it could be a leading indicator, especially during high uncertainty times. That's why we elaborated it especially during this COVID crisis period. I think so.
Yeah, thanks. I mean, it might be useful still to have some historical evidence of how I mean, on whether different concepts of inflation have predictive power on the ultimate targets of the central bank. But I think all the caveats you raise are very useful, and of course the degree to which a price is flexible or sticky, and how quickly prices adjust depends a lot, as you pointed out, on inflation expectations and the overall macro environment. Can I ask something more? It's more of a clarification question. You seem to be going back and forth between sticky versus flexible prices and traded versus non-traded prices. And it was not clear exactly what the distinction was. I assume that some traded prices can be quite sticky. Some goods prices can be sticky. So what is the and correspondingly some services or non-traded prices can be quite flexible. So what is the distinction there that we should focus on?
So at first we separated traded from non-traded, because we want to be out from the exchange rate any fluctuations, any shock that can be out of our control at some point. I think it's easiest part for us to diverse these two parts, traded and non-traded. What non-traded and flexible and sticky one. So, of course, let me say that I dive deeper for EU. I found the 5-digit data, and I checked one by one, which is flexible and which is sticky by their average movements from their monthly changes. But also in the concept, you can understand that, of course, the prices of the restaurants and hotels, of course, they can be more flexible because they are driven from the touristic parts or the other components. At the same time, you can understand that, for example, the repair of the house and the shoes and clothes, it's more a stable one, which could contain some market expectations or feeling. Also the haircuts, services, like, yeah, they are more stable. And if your hairdresser decided to change its prices, it must be driven in some forces. So for the methodology part, I dive deeper and deeper to understand any part that can be out of the basket. And if I could cover your question, it's good. If not, I can clarify.
So, what part of services is in the euro area? I mean, what percent of prices of service prices are sticky rather than flexible? Would you?
I think here is mainly coming this 53, for example, percent is mainly driven from this services part, because we had a very small part of goods. It's mainly services that is here. I think about 50% of services are sticky for euro area. And of course, let me say for US, it's about 70%, and for Armenia, it's less than 30%, which means that it can be different for different countries.
There's a big difference.
Yeah,
And what about goods? What percent of goods prices would you think are
I think
sticky?
it's very small, because I just checked them by this statistical method. I just calculated the average and put median and took the below average frequency for the goods. And I think very small goods that can be, for example, animals, pets, and some I don't know, maybe flowers, something like this. I found that it could be not flexible part of the basket.
Right.
Newspapers, something like this.
Yeah. No, this is very illuminating. And so your overall now take, if you focus on your sticky price inflation, what does this tell us about the inflation outlook, do you think? How would you interpret the recent movements?
So sure, at the moment, it's still higher than headline. It's still higher than core. Of course, it contains some information about the persistency. And even in US case, it's also higher than the current headline at the moment. But we feel that it's coming from US in the consumption part, so it can contain some excess demand pressure. But for EU, for euro area, I think that it's mainly driven by the market expectations. So the uncertainty for them is still high. That's why this stickiest part of the basket is not fast in their change to the decline as we had seen in core. So that's why I think that the anchoring of market expectations can be case for them, even if we will have some small changes in flexible prices. Even some small change in the flexible prices can affect on the anchoring of market expectations, and we can even see the movement change and higher pressures in the inflation here. I think this is a clear information about the market expectations that are much higher. So this is what I see here.
Thank you, Diana, and thank you, Yanis, for your perspectives on this matter. It was indeed very insightful. Now we can look at the case of UK, which I think is nonetheless interesting, especially given their recent decision to cut the rates despite very high service inflation. Svetlana, can you please show us your work on non-traded sticky prices for UK? Great. Can you change the slide, please? It's not. Okay, great.
Hello everyone. I'm Svetlana from Central Bank of Armenia, and now I would like to introduce you this non-traded sticky price inflation for the United Kingdom. So what we have here is that I would like to start with the FPAS central banks, and as Central Bank of Armenia is now in the can you see the slides or yeah?
Not anymore.
Yeah, we've lost them. Now we see them again.
Okay, and now you can see, yeah?
Yes.
Okay. As every central bank in FPAS Mark II framework, we know that every central bank being in the FPAS framework have to answer for the three main questions. We know that the first question is where is the economy now? The second one is what are the underlying forces driving the current economic trends? And the third and last one is how should we adjust our policy instruments to achieve our goal and to achieve our primary objective. So as we know, the United Kingdom Bank of England is not the FPAS central bank, but as we are now working in the Central Bank of Armenia, and looking at the different type of country cases, so we just need to look at them from this FPAS Mark II perspective, and to address these three main questions effectively, we need some reliable also measures of underlying inflation, and typically central banks use underlying inflation measure to track some price dynamics and determine whether there is a need for policy intervention or not. As Diana already have mentioned about the methodology and something about the headline and core inflation, I don't want to say it again. So I just want to say that as we know, so the examples of the core inflation and also headline and also another underlying inflation measures has many drawbacks. And in our research, we propose this new decomposition to better capture slow moving and infrequently adjusted prices. What we have, let's look at the results for the United Kingdom. So you can see this non-tradable sticky price inflation, which is a blue line. What we have here, obviously, there are some problems in terms of how the weights are available and how the data is available. But up to now, what we have, and also I want to mention that this is like a few days that I'm working on the United Kingdom's case, what we have for now is more or less in line with the historical narrative of the United Kingdom's economy, and especially in the recent period after COVID-19 pandemic, in this high inflation environment, it's more or less in line what we think happened in the United Kingdom, and we see that the non-tradable sticky prices are highly elevated and they are way above the target, and this suggests that maybe, first of all, expectations could be disanchored from the target, indicating that there is more room for the central bank's policy here. And also I would like to share with you the short-term and medium-term expectation, which is the from the households and business sector. So what these survey results tell us about the inflation expectations. So, and also I would like to mention that starting from 2010 up to COVID-19 pandemic, so inflation remained somehow stable, and it's like was about the 2 to 4% this between these 2 to 4%, and also, these periods suggest that inflation expectations were some relatively well anchored and aligning with the Bank of England's target. Inflation dipped significantly during the early stage of COVID-19 pandemic, with several months slowing also near zero or even negative inflation. And also following the initial pandemic shock, inflation began to rise sharply, and by June 2022, headline inflation reached 9.1%, and this is somehow reflecting supply chain disruption and also increased demand and also other pandemic-related factors. And for now, although inflation began to decline from its peak, but it remains somehow elevated. So we have that headline had moderated to 2.2%. This is like somehow suggests that there is some stabilization, but still above the pre-pandemic levels. And what about the inflation expectations? So the significant rise in both inflation perception and also short-term expectation during 2022, which corresponding with the headline inflation peak of 11.1%, which was in October 2022, suggests a period of disanchoring where households were somehow uncertain about the Bank of England's ability to control the inflation. And the recent decline in headline for previous months, along also with a decrease in short-term inflation expectations, may indicate that somehow households are beginning to believe that inflation will return closer to the central bank's target, signaling a potential re-anchoring of expectations. And additionally, I would like to link this non-traded sticky price inflation with the
Yeah, sorry, Svetlana, can I ask if you could go back to the previous slide, just for my understanding, what horizon of expectations are these? I mean, I see that short-term and medium-term expectations have pretty much converged, right, to their historical pattern. But what is the current inflation perceptions for household? What
So this is like what they are thinking about the current inflation rates. So this is like the survey results about what they are thinking about the for now's inflation. Like
what's the inflation currently?
Yeah.
Okay. Okay, but so the short term is a year ahead inflation?
Short term is like no, it's like 1 year next for next 1 year, and the medium term is like after the over the 1 year ahead inflation expectation.
Right. So, but doesn't this suggest that at least even for the households that the expectations have pretty much converged to the Bank of England's target?
Yeah, it's telling some that when we look at the also short term and medium term, we can see that somehow it's for example, in the latest result we have nearly 3%, which tells us that like somehow it's converging to the target of the ECB's target.
Yeah, okay, thanks. I was a bit confused about the current, what it was, but yeah, thanks.
Okay, and I want to link also the non-traded sticky price inflation with the wage growth, and also there is inflation premium embedded in wage and also price setting behavior, meaning that also firms are still pricing this inflation premium into their pricing and wage decision. So like we have here the private sector's wages. So when I look at the, for example, total economy's wage growth and private sector's wage growth, I can notice that the two are like somehow going together. So they are somehow co-vary. And for example, what we see after COVID recovery in the high inflationary environment, wages started to increase, and then non-tradable sticky prices followed because this high wage cost was obviously costly for firms, and they started to price this cost and to compensate for it. So we can say that wage growth, which is still high, and we can see that this is somehow declining, but this is for now it's 5.2%, and this could be one of the drivers or one of the reasons why we see a very sluggish decline in these underlying inflation measures over the past several quarters. And this indicates that inflationary pressures are still present in the United Kingdom's economy, and the Bank of England might need to have maintain a tight policy or proactive policy. So when I also looked at the headline inflation, and also when we compare the headline with the non-traded sticky price inflation, this is like, I think, somehow the exact example that can illustrate how important it is to have these non-traded sticky price inflation measure for the United Kingdom. So I think that most people in the Bank of England look at the headline and they believe that rates current are plausible. But when we're looking at the non-traded sticky price inflation, we can see that this measure telling us another, like the opposite. And there are some significant pressures because the gap is huge between the non-tradable sticky prices and also the headline, or between the CPI and the target. So in other countries like US and also Euro area, there is also a gap between this non-tradable and also headline, and also gap between the CPI and the target. But this like somehow it rounds around 4%. So it's really important to have like this measure for the United Kingdom. So this measure, I think, will need some further improvement. This is not the final version of it, but I think these results agree with what we think about the current situation, current inflation in the United Kingdom's economy. So I think that's all for this moment.
Yeah, thanks, Svetlana. Could I raise a general question which has to do with the methodology, but I think it's more relevant to the UK since it's a very open economy. I think one needs to be a bit careful on how to interpret deviations between the two price indices that you're focusing on, the overall and the non-traded sticky price. Certainly, I think you make a very good case, both of you have made a very good case why there is a lot of information if one focuses on non-traded sticky prices. But at the same time, one has to recall, right? I mean, when there are big deviations between the two, there could be very good reasons why the two deviate. I mean, after all, the ratio, what is the ratio of traded versus non-traded goods, right? It's the real exchange rate. And there could be real fundamental reasons why the real exchange rate can fluctuate in either direction. And since these countries are inflation targeters, both the Euro area and the UK and the Fed in the US, they may not want to offset at least fundamental driven changes in the real exchange rate. Should one make a distinction, do you think, between these two, or at least try to understand why the two may be deviating? One may be that there are lags involved, so non-traded prices could translate into overall price changes, but at the same time, it could reflect fluctuations in the real exchange rate that should not be resisted necessarily. So if one focuses exclusively on non-traded prices, there might be essentially it may not be a good idea, essentially, if what you care is the overall price level. How do you see this? I think this is for both. I think it applies more to the UK since it's much
Yeah,
more open and real exchange rate changes play a much bigger role.
I think both of them ideas are interesting. But I also want to mention that when we compare this also headline with the core inflation, so we can see that also the core inflation is continuing to decreasing, and it is like if I'm not mistaken, for now it's 4%. But when we look at the headline inflation, it is about the 2% to 2.2%. So we can see that also when we see this much difference between these non-traded sticky prices with the headline, we also have this gap between the core and also this like headline inflation. So I think that as I mentioned, that I think they are looking at only the headline CPI, and they are just based on this headline, they are like making their decision. But I think so if the non-traded sticky price inflation, it's not a good measure, as they are a very open economy, and this is not a very good idea. So I think that they can somehow make their decision based on some other measures. So, for example, they can use different type of these underlying inflation measures, and based on all the measures, they can make their decision for the economy. But when we look and comparing these interest rate cuts, and when we look at that the headline is 2.2 and the non-traded sticky price is 5.6%. So we can see that this non-traded is not telling us a story about rate cuts. Maybe there is a need for more attention, yes, for the exchange rates part, and maybe we need to construct this non-traded sticky price inflation for the United Kingdom more accurately based on their openness and etc.
Great. No, I think that'd be useful. But thanks very much. This was illuminating also on the core versus the overall, because after all, that is now the core inflation, of course, compares. I mean, the headline, the difference between headline and the core includes both very volatile items,
Yeah.
and then includes also energy, right, which is more, which has been very variable recently, but is currently on the decline. So, how do you think? I mean, fresh fruits and vegetables, for example, I think people reasonably ignore them because there's so much noise in these movements that there is no point in targeting them. But how do you think, so what's your understanding of both the ECB and the Bank of England? How do they react, or how should they react to persistent energy price changes, for example, in your thinking?
So I think that as there was some energy crises both in the ECB and Eurozone, and also in the United Kingdom. So this is like telling a story about that they need to be very cautious with these energy prices, as so they have some bad story with the energy crisis. So I think that they need to look at the energy prices, and also being an open economy, and also like ongoing conflict in the Israel, I think it's also somehow impacting on the United Kingdom's economy and also Euro areas as well. So I think energy prices are important indicator for the both economies. And also they have periods for energy crises as well.
Can I add?
Yeah, please, Diana, absolutely.
I just wanted to highlight here that even energy prices is out of core, but of course it's had a humongous impact on this secondary effect. It even can affect on the services prices. And I think that even their inflation started with the energy crisis, they needed to affect immediately on these secondary effects, and they even delayed that part because they just wanted to communicate that it one-time shock and we will cut it, we will fire with it. And I think they missed these secondary effects and they de-anchored their market expectations. I think their failed monetary policy started from this part. I just wanted to add it. Thank you.
No, thanks very much to both of you. These are very, very nice presentations and very nice, interesting responses.
I completely agree. Both are very interesting. I just want to add that with UK having a very low productivity growth and growth in wages, we are maybe seeing case when we are above the maximum output gap and an additional excess demand is just inflationary. It could be that horrible case as well when there is no increase in productivity, but inflation keeps rising. So it may be sticky price inflation could give us more insight about that as well.
That's a good point, yes, I agree.
Thank you. So I'm not sure what we are doing now. We are out of time and we have Annie's presentation left. Annie, would you like to have a go? Like, would it?
I can go.
Ioannis, would it be okay with you?
I'm fine, yes. But sorry, I took a lot of more of your time than I should have. But
it was very insightful. No, it was the questions were great.
As possible.
Okay, so Annie will be presenting about chart packs, right? Okay. The stage is yours.
Let me share my screen. Hello, everyone. I am Annie from Central Bank of Armenia, also a student at the Global Forecasting School. Firstly, I want to share with you this chart pack that we have created for the US economy. So it is a comprehensive analysis made for economists to get a better picture for the economy, and it reviews and the main variables of the economy, such as consumer price index, labor market, households balance sheets, and so on. And in this consumer price index, we are also monitoring these brand new sticky non-traded prices that my colleagues have just introduced. So we are currently constructing these sticky non-traded prices for many economies, and as Diana has constructed these sticky non-traded prices for the ECB, I have also incorporated this constructed measure in the chart pack for the ECB. So we are simultaneously trying to construct a chart pack, similar chart pack for the ECB as well, and it is still on the progress. But I can show you some graphs that we have already constructed and generated for the ECB version. And so this is our developments for the ECB, the chart pack version. And firstly, so I don't want to talk about this chart pack in a technical way, but I want to present these graphs and talk about the underlying and present you the underlying story. So firstly, I will start with the recent developments that shows the ECB's recent policy. And we have seen that there was a rate hike going on after the pandemic after pandemic, in the post-pandemic period. We have seen that the ECB has implemented a series of interest rate hikes over the past year to combat these rising inflationary pressures coming
post-pandemic pent-up demand, and these hikes of the interest rates they have been aimed at cooling down the economic activity and preventing inflation from spiraling out of control. So besides this monetary tightening, besides this raising of the interest rates, ECB also has been engaged in quantitative tightening, which involves procedure of such as reducing its holdings of government bonds and other assets, and this aims to reduce the amount of money circulating in the economy and further tighten the monetary conditions. So the ECB's overall goal is to hold the interest rate, is to adjust the interest rates sufficiently aggressively to anchor the inflationary pressures and inflationary expectations, and to anchor inflation at 2% target. So this is their primary objective, and by adjusting their interest rates, they try to achieve their objective. And looking at the data of inflation, headline inflation, we can see the impact of this monetary tightening that has been taken place after COVID, after pandemic. We can see that if I want to come from the pandemic's period, so in the pandemic's period, we have seen that there have been supply chain disruptions, and as a result of that, the production has decreased. So the economies, the central banks tried to do monetary easing to boost the economy and to generate this demand, and also to increase the production as well. So as a result of that, we have seen also as a result of that, and also after pandemic, after this whole restrictions have ended, we saw that there was a pent-up demand in the economy, and so these really lead to inflation, curb inflationary forces to increase, and we saw that headline inflation has reached its peak in the late 2022. And it was driven by this pent-up demand in the economies. Since then, ECB tried to, as I have already showed, they tried to do monetary tightening, both in conventional and unconventional measures, by using these measures. And since then, this headline inflation has been on a downward trajectory, indicating that inflationary pressures have been easing. So if we look at this headline inflation of the year-over-year growth rate basis, we can see that recently even they have almost converged to this 2% target. So looking at this headline inflation, we might think that the monetary policy measures may be having the desired effect. But this is actually misleading, because we also have to look at these non-traded sticky prices, which actually show that they display these pure inflationary forces, which are not affected by external factors coming from the supply side, by this exchange rate transmission mechanism. Also, they do not incorporate these short-term fluctuations. So that's why it is important to consider this non-traded sticky price index as well, because they show these purely underlying inflationary forces in the economy, and they incorporate these expectations in the economies. So looking at this non-traded sticky price index at the right-hand side of the picture, we can see that this non-traded sticky price index, both year-over-year and this 3 months over 3 months annualized basis, they have remained relatively high throughout the period. So this suggests that inflation pressures are persisting in sectors that are less exposed to international competition and price fluctuations. So the index remains above the target, and this suggests that ECB should be careful in doing their policy making and trying to cut the interest rate when they see that the headline inflation is coming down. So as a result of that, we can see that there is a divergence between headline inflation and these non-traded sticky prices, and this divergence poses a challenge for policymakers. So we can see that while headline inflation has been moderating, the persistent inflation in these non-traded sticky prices could still pose some elevated risks, upwards risks for the economy. So and this addresses that the underlying, there might be still underlying issues in the economy coming from the coming from the various sides of the economy, such as labor market tightness, wage growth, and regulatory constraints, and so on. And also it indicates that market expectations are still elevated. So speaking of the labor market, we have tried to display the wages, but we failed to find the wage data on a month-on-month basis. It was on a quarterly basis. So we have incorporated this unemployment rate data, and looking at this unemployment rate, we see that at first we saw in the pandemic period there was a sharp increase of the unemployment. The unemployment rate sparked dramatically in the early months of the pandemic, and it reached to its peak in the late 2020. And this surge largely was due to the lockdowns in the economies, due to the restrictions that led to widespread job losses and business closures. So after pandemic, in this post-pandemic period, we have seen a rapid recovery in the labor market. So because of the both monetary easing and also the government support, we saw that these really helped to mitigate the worst effects of the crisis that were coming from the labor side of the market. And as restrictions has eased and the economy is reopened, the unemployment rate began a steadily decline. Another thing that I want to mention here is the convergence of the Naira level. So we see that this Naira rate, which is about 6.7%, in the recent developments, we saw that not only unemployment rate has converged to Naira level, but also it decreased, and now currently it is below its Naira level, which indicates this overheated labor market in the economies, and this can pose inflationary pressures and create this wage price spiral, and so this creates a room for the KSA type scenarios in the EU area. So also because of this, we can say that these non-traded sticky prices remain elevated because of this overheated labor market. People's expectations are still on the upwards trends in terms of the inflationary risks. So they expect that the inflation might still persist in the economy. So these inflationary expectations are still elevated, and unemployment is below its Naira level. And we have also monitored the trade sector. So this EU trade sector have rebounded from the COVID-19 disruptions, and we can see, looking at the exports and imports data, we can see that these, looking at the upper right corner, we can see that this year-over-year growth rate of the goods exports have experienced a significant spike in the early 2022 as a result of this pent-up demand in the economy that I have already told about. And after ECB has raised their interest rates and tried to curb inflationary pressures in the economy and tighten monetary conditions, the experts, both in year-over-year and 3 months over 3 months annualized basis, they have declined, and this decline was shown in the services as well. But if I want to compare these exports of goods and services, I can say that the year-over-year growth rate of services exports has exhibited more consistent upward trend in this part when we had this pent-up demand. And it suggests a stronger and more resilient recovery compared to the goods exports. So comparing this, and also we can see the picture is the same, basically the same in case of imports as well. So imports of services are more resilient compared to the imports of goods. And so these data basically suggest that there was a potential shift of consuming from consuming goods to consuming services. So this can be because of the behavior shift in the households' consumption because of in the pandemic period, and this behavioral shift continued after pandemic as well. So we can see that the services play more prominent role in the composition of the exports and imports as well. And this could be attributed to other factors as well, such as the recent digitalization of the economy and also the increasing importance of the knowledge-based industries as well. And also the change in the consumer behavior that I have already told. So this is it for now. We are trying to not restrict ourselves and try to expand the scope of our research and try to monitor as much information and as much variables as we can for the ECB and incorporate it into our chart pack, and also try to construct. This will lead to construction, eventually the construction of the our version of the GDP now for the ECB's case. So that's it for now. Thank you. If you have any questions, please.
Thanks, Annie. This was quite comprehensive and interesting. One thing that puzzled me a bit is compared to other cases that I've seen, there seems to be very large differences in 12-month versus annualized growth, both on prices and on exports. Do you take these? I mean, obviously, there has to be some seasonal adjustment on the 3 month to 3 month. Makes sense, right? To annualize. But do you think the correction for seasonality is accurate? Because it's very. I mean, suppose you were, for example, if you're looking at the 3 month over 3 month annualized on the chart you have here on the screen. Sorry, I'm looking ahead because I have a monitor so I can see it a bit bigger. If you were in the beginning of 2024, you would say, well, my 3 month and 3 month annualized, which in many ways should be a more valuable, a more useful guide, right? Because it's forward looking, is at zero, right? Or is that my target?
At target.
Yeah. at the end of 23, beginning of 24. I don't know if I read this correctly. I'm looking at your chart on the right-hand side. So, but
This
this,
one is
of course, would be a bit misleading because, I mean, why is there so much variation? I mean, it's just it seems unusually large, the deviations between the 12-month and and when you look at your imports and exports, then you have huge differences. I mean, one is almost zero growth, the other is 20% growth. So, I mean, maybe it's something technically one can look at how the seasonal adjustment has been done and whether it's one needs to a bit to correct it if there are issues there. That was my only pass by looking at your charts.
Thank you so much for the comment. Yeah, I really appreciate this suggestion. And I was also, before presenting, I was also looking at these charts and thinking that really the gap between these 3 months over 3 months and year over year is huge. And I can say that yes, part of that comes from this seasonally adjustment thing here. About the target, I can say about these lines, I can say that these are actually the targets that we have. For the headline inflation, we have 2%, and the non-traded sticky prices, the target for this is below 2%, around 1%. And yes, I will try to analyze why there is so much volatility in this 3 months over 3 months annualized series, and try to eliminate this volatility if I can. If I can do some seasonal adjustment, I will definitely do and incorporate
No,
it.
I'm not suggesting that you eliminate the difference because they say different things, right? One is a backward-looking indicator, the other is supposed to be forward-looking indicator. But all I'm saying is that I mean they don't have any. I mean the 3 month over 3 month annualized seems to be. I mean the 12 month is nice monotonic decline over time. The forward-looking part goes up and down, and it's hard to interpret it. I mean, in principle, you would think that the 3 month over 3 month annualized, if appropriately seasonally corrected, should be a more useful indicator. It tells you, I mean, it's a forward-looking indicator. So it should be a better guide. But given that it varies so much, I'm not sure if it can be usefully employed as it should be in principle. That's all. I'm not saying that that the two should move together, but one is very smooth, the other is jumping all over the place, and it could be an issue of seasonal adjustment. That's all I was trying to say.
Yeah, thank you so much. Yes, it could be because of this seasonal adjustment. I'll try to also adjust, do this seasonal adjustment and see if it is still this volatile or not.
Let me just say that yes, the problem is coming from the seasonal adjustment part, because the initial codes were for US, and the US data, you can easily find the CPI detailed data for by seasonally adjusted one, but for Euro area and UK, we couldn't find a seasonally adjusted data. So because codes were for US, we didn't manage to add this part as well. But of course, we will add this, and we will have better lines here. And for our future works and analysis, of course, we will incorporate that lines as well. Of course, year on year don't have this seasonality problem, and we wanted to mainly emphasize this one. But for 3 month over 3 month, I think that it's solvable problem. So I hope that Anya will give us some nice codes for seasonally adjustment. Thank you.
Great, thanks. No, that would be very, very useful. Thanks.
One thing I want to show you. The same problem is for US as well. I can actually show you. I have this chart pack here, which shows that here, if you can see, we have constructed this core PCE measure 3 months over 3 months and also year over year. And you can see that basically it's the same for the US as well. So this problem about these 3 months over 3 months being so volatile is here for the US as well. Here you can see that 3 months over 3 months is basically more volatile than the year over year. Moreover, if we look at the months on months annualized, we can see that it is way more volatile than the 3 months over 3 months annualized version. So I guess it's because of the frequencies and seasonality as well.
Yes, absolutely. The shorter period that you're looking at will be more volatile. So there's that issue as well. Well, to sum up what we have discussed today and what we believe the main merit of looking at different countries is that we are trying to have a holistic approach at economics. When we see that that certain indicators point to certain things which are consistent with economic theory and which is true across countries, which is what we are trying to point down. So when we see that what we think is true for the USA, which has been the focus for GFS for the past 2 months, the work that the three of you have done is very valuable, which because we saw that economic concepts which were true for USA, and USA was chosen by GFS because of the plethora of data it has. So we have flexibility to assess economic theory using USA's very wealthy database, but the output that you've given about UK and Euro area and European Union is also very interesting for us, and thank you for that. And I also want to say that these projects are very new. I think you've been working on it for just over a week, so what you've given us is very great, I think. So Ioannis, again, thank you so much for being here today. I would appreciate if you have anything else to add to today's session.
No, thanks, Tina. No, this was, I mean, it's amazing. I mean, the work that has been done over such a short time. Certainly, it was very informative for me. I learned a lot, and thank you again for the opportunity.
Thank you so much, everybody. Thank you, Ioannis. Thank you, Diana and Svetlana. That was our session for today. I hope you learned as much as I did. I think that was it for today. Goodbye.
Thank you.